The Hedge Fund Edge. Maximum profit, minimum risk. Global trend, traded strategies. By Mark Boucher. What if I told you that making money in the markets isn't just about picking the right stocks, but about understanding the hidden forces that drive market trends? Imagine being able to consistently pull in profits while sidestepping devastating market crashes, the ones that have wiped out fortunes in a matter of days. What if there was a way to not just survive in the markets, but to thrive no matter what the economy throws at you? Today we dive into the mind of Mark Boucher, a hedge fund expert who cracked the code to global trend trading and revealed a strategy so powerful it has been used to double market returns while slashing risk in half. And here's the best part: you don't need millions to apply these techniques. You just need the right mindset. Before we get into the juicy secrets, let me take you back to a defining moment in Boucher's life. A moment that changed everything. The painful lesson of risk. The year is 1972. The markets are flying high, investors are making money hand over fist, and the so-called experts are chanting the same old mantra: stocks always go up. It was the early 1970s. Mark Boucher was just a child when he experienced firsthand the brutal reality of financial markets. His father had spent years working, saving, and carefully investing. His dream? To leave behind a secure future for his son. Mark Boucher's father was one of those investors. A hardworking man, he wanted to secure a bright future for his son. So he did what financial advisors told him was the smartest move. He put his money into the stock market. He had set up a trust fund, one that was supposed to go steadily in the stock market, ensuring that Mark could one day attend an Ivy League school, debt-free. At first, it seemed like a dream. The market was soaring. The trust fund he set up for his son was growing at a steady pace. The future looked safe, predictable. Mark's college education paid for. No worries. No stress. Then came 1972. The first cracks appeared. Then the panic set in. Then the crash. The trust fund, which was meant to last a lifetime, had lost over 70% of its value. Not a little bit gone, not a bad month or a tough year, 70% gone. The trust fund, once large enough to pay for an Ivy League education, was now barely enough to cover the basics. Young Mark didn't understand the intricacies of the stock market yet, but he did understand what it felt like to watch security turn into uncertainty. He saw the impact that blind trust in the markets could have on real lives. He saw the cost of failing to manage risk. What was once a golden ticket to a secure future had evaporated in a blink. Mark's father had believed in the safe wisdom of buy and hold investing. Just ride it out, they said. The market always goes up, eventually. But eventually didn't help Mark. By the time he was ready for college, the fund had barely recovered. The Ivy League dreams? Gone. He had to settle for a more affordable option. This was the moment that planted the seed. Mark Boucher vowed that he would never let the markets take him by surprise again. Fast forward to the early 1980s, Mark was finally heading off to college, but instead of stepping into a world of endless possibilities, he stepped into something much different: the reality of financial struggle. His father had done what he thought was right. He had followed conventional wisdom, but conventional wisdom had failed him. And that's when something clicked in Mark's mind. He didn't just want to recover from what had happened. He wanted to understand it. He wanted to know why markets crashed. He wanted to know why some people lost everything, while others thrived. He wanted to know how to make money while avoiding catastrophic loss. And so, his journey began. He spent the next decade obsessed with understanding how markets worked. He devoured books on trading, investing, and economic cycles. He pored over data, searching for patterns, warnings, and opportunities that others missed. And the more he learned, the more he realized. Most people didn't lose money because they were bad investors. They lost money because they didn't understand risk. They believed markets were safe, until they weren't. They believed crashes were rare, until they weren't. They thought they had time to react, until it was too late. This lesson, the brutal, unforgettable lesson of risk, became the foundation of Mark Boucher's life's work, and it became the foundation of his book, The Hedge Fund Edge. Because if you don't manage risk, it will manage you. But here's the twist: not everyone got crushed in 1972. Some investors, those who understood the hidden forces of the market, made millions while everyone else was panicking. What did they know that the average investor didn't? What made them different? And most importantly, how can you think like them? The financial world has always had its legends. Investors who seemed untouchable, who thrived in every bull run and somehow dodged every crash. Ever wondered what separates an average investor from a market master? Why do some traders seem to ride the waves of the market effortlessly, doubling, even tripling their wealth, while others get crushed, watching their life savings disappear in a single downturn? Is it luck? Is it insider information? No. Mark Boucher wanted answers. He dedicated years to studying the world's greatest investors: Warren Buffett, Paul Tudor Jones, George Soros, Peter Lynch, Ray Dalio. The legends who had built fortunes not just in good times, but in market crashes, recessions, and global financial meltdowns. And what he discovered wasn't what most people expected. These traders didn't rely on some magical system. They didn't make wild bets or time the market perfectly. They followed a set of ironclad principles, rules that allowed them to thrive while everyone else panicked. Boucher identified 3 critical habits that all of these investors had in common. And if you master them, you could change the way you invest forever. Habit number 1: they never bet against the tide. Think of the market like the ocean. You could be the strongest swimmer in the world, but if you're fighting against the tide, you're going to drown. Yet, this is what most investors do. When the market starts crashing, they hold on to their losing stocks, believing it will bounce back. When a stock is surging higher, they hesitate, waiting for the perfect entry that never comes. Market masters don't fight the trend, they ride it. If the economy is booming and liquidity is strong, they go long. If the market is in free fall and panic is spreading, they step aside, hedge, or short weak assets. Paul Tudor Jones became a legend by mastering this simple rule. The most expensive words in investing are, "This time it's different." He never fought the trend, he anticipated it. Remember, the market doesn't care about your opinions. The trend is your friend until it ends. Habit number 2, they focus on liquidity, not just prices. Want to know the number 1 mistake investors make? It's not picking the wrong stock. It's not buying at the wrong time. It's not even missing out on a great opportunity. It's thinking they can predict the market instead of reacting to it. It's getting emotionally attached to their trades. Let me paint you a picture. Retail investors get trapped by hype. They hear hot stock picks on CNBC. They chase trends after they've already played out. And when things go south, they hold and hold and hold. But hedge funds, they don't care about headlines. They don't chase fads. They follow liquidity because that's what truly moves markets. When central banks pump money in, they go long. When liquidity dries up, markets collapse, no matter how great a company's fundamentals are. When liquidity dries up, they move to cash, short, or hedge. The market is like an ocean. The tide moves in cycles. If you don't watch it, you'll drown. And that's why hedge funds always watch the liquidity cycle. Think about it. 1999, the dot-com bubble, every tech stock was soaring. Companies with zero profits were worth billions. Investors believed the internet had changed everything. Then, the bubble burst. Tech stocks crashed by 80%, wiping out trillions of dollars. 2008, the financial crisis. The housing market was booming. Mortgage-backed securities were risk-free investments. Then, the crash hit. The banks collapsed. The stock market fell nearly 50%. But here's the thing. Smart investors, like Boucher, weren't caught off guard. They saw the warning signs. Valuations were too high. Risk was too extreme. Never buy an overpriced market. Look for undervalued sectors where liquidity is strong. Avoid hype stocks and bubbles. Use valuation gauges to measure how much risk versus reward is in a trade. Because real wealth isn't built by chasing trends, it's built by buying low and selling high. Let's take another real-world example. March 2020. COVID hits, the world shuts down, the market crashes 30% in weeks. So panic, fear, selling everywhere. But then something happens. The Federal Reserve steps in, they inject trillions of dollars into the system. Interest rates are slashed to nearly zero. And what does the stock market do? Boom! The biggest rally in history. Anyone who understood the liquidity cycle knew what was coming next. Boucher's rule: invest only where liquidity is flowing. How does he do it? He tracks central bank policies worldwide. He follows interest rate cycles to predict capital flows. He watches bond markets, because where money moves first, stocks follow. And the most important part, exit before the crash, because when liquidity dries up, the market doesn't just slow down, it collapses. Hedge funds that ignored the liquidity cycle, they got crushed in 2008. Hedge funds that followed it, they made billions. George Soros once said, "When I see a bubble forming, I rush in to buy, adding fuel to the fire. But I get out before it bursts." He wasn't guessing, he was watching liquidity flows. The fastest way to lose money? Buying at the wrong price. And yet, it happens every single time a bull market takes off. Investors get greedy. They think stocks will go up forever. They ignore history, valuation, and risk. Boucher once. Bull markets create illusions. The greatest investors don't buy when stocks are hot. They buy when valuations make sense. The biggest mistake retail investors make? Buying at the wrong time. A bull market can trick you into believing stocks will go up forever, until they don't. Boucher uses strict valuation gauges to know when an asset is overpriced. If it is, he moves his money elsewhere. Instead of guessing, Boucher reacts to market movements. He follows big trends instead of fighting them. If the market is bullish, he rides the wave. If the market turns sour, he cuts exposure, hedges, or moves to a different asset class. This is how hedge funds win. They don't just pick stocks. They position themselves in the right place, at the right time. And that's why Boucher's hedge fund clients have outperformed the S&P 500 while taking on half the risk. Habit number 3, they manage risk. Like a pro. Let me ask you something. If you had to choose between a strategy that made 100% returns but had a 50% chance of wiping out your entire portfolio, or a strategy that made steady 15% returns with minimal risk, which would you choose? Most people pick the first option, chasing big wins. And that's why they fail. Market masters know the truth. Your first priority isn't making money, it's protecting it. One bad trade should never wipe out years of gains. Ray Dalio, one of the greatest hedge fund managers of all time, built his empire on this principle. He doesn't bet on single trades. He diversifies across uncorrelated assets. He hedges against risk so that even when he's wrong, he still wins. If you don't manage risk, it will manage you. These are the principles that separate the amateurs from the market masters. But here's the real question. How do you actually apply this in your own investing? The story of two investors. It's 2008. The stock market is booming. People are making money. Wall Street is throwing around words like unstoppable and once-in-a-generation bull market. Enter Joe, a regular investor. Joe watches CNBC every morning. He reads stock forums. He's got his money in big hot stocks like Lehman Brothers, Bear Stearns, and AIG. Companies everyone believes are too big to fail. Then, one day, the headlines shift. Subprime mortgage crisis hits. Lehman in trouble. Market volatility surges. Joe panics, but the so-called experts tell him to stay the course. It's just a dip, they say, but the dip turns into a collapse. Lehman goes bankrupt. The stock market plunges. Joe watches his portfolio bleed. But instead of cutting losses, he holds. It'll recover, he tells himself. The market always goes back up, his friends reassure him. But it doesn't. Joe's portfolio is destroyed. Years of savings, gone. Now let's rewind. Same year, same market, same warning signs. But this time, meet Sarah, a hedge fund manager. Sarah doesn't predict the market. She follows it. She watches liquidity flows dry up. She sees the big players, hedge funds, institutional investors, start to exit. She sees that stocks like Lehman and Bear Stearns are acting weak despite the media optimism. And she does what smart investors do. She reacts. She cuts exposure. She hedges her bets. And when the crash finally hits, she's not holding the bag, she's profiting from it. This is the difference between a retail investor and a market master. So why did Joe lose everything while Sarah walked away with gains? Because Joe was married to his trades. He believed in his stocks like they were his favorite sports team. He refused to accept he was wrong. He refused to cut his losses, and in the end, the market humbled him. Sarah, she had no emotional attachment. She followed the data. Hedge funds don't fall in love with stocks. Hedge funds don't hold on to losers. Hedge funds don't gamble on predictions. They react to reality. Their secret? Risk management first, profit second. Why? Because small losses are recoverable. Big ones aren't. If a hedge fund takes a 5% loss, they can make it back with one good trade. But if they take a 50% loss, they need to double their money just to break even. And most people don't understand this until it's too late. Now here's what makes hedge funds different from average investors. When a stock is showing real strength, they hold it. When liquidity is pouring in, they keep riding the wave. They don't sell just because they're up a little. They stay in as long as the market is moving in their favor. So what can you take away from the Hedge Fund Edge? Invest with the trend. Never fight the market. Protect your capital. Risk management is everything. Look for the right valuation. Never overpay. Want to trade like a hedge fund pro? Then stop looking for magic stock tips and start thinking like the smart money. Smash that like button if you found this valuable. Subscribe for more market wisdom and let me know in the comments, what's your biggest investing lesson? Stay sharp, stay liquid, and trade like a master.